Welcome back. Today we're talking about how I'm biased in my stock market investment practice and how actually this has been more of a hindrance than it has been a positive to my investment strategy and what I have learned truly from it. Now, this was initially flagged by a viewer on the channel. However, I had misinterpreted it for the wrong thing. Now, this is the idea of being patriotic bias. And now, before I continue, if you like this video and think it delivers more value than usual, then please drop one of these, as it does help out a lot and it allows other viewers to know which ones are the best videos with the most value. So, patriotic bias, what does this mean? Well, it means effectively that I believe more in my own country or where I grew up in than, let's say, other places. Now, I wasn't biased on that level, but the same premise applies, right? I don't believe that England or the United Kingdom is going to outperform any other geographical area. I simply don't have the knowledge for this, nor am I willing to gamble on it. Despite saying that, and despite not being willing to gamble on it, I've still effectively gambled on it where my investments are located. Now, this was initially flagged up by a viewer named Andy. Now, he had mentioned quite a few times and had flagged it up for a good year, so quite a while here where I was reading this and still disagreeing, and now I truly kind of understand what was meant. Now, initially, I'd felt that this was to do with revenue or earnings, right? Let's say we've got a company, let's say it's Boohoo. Boohoo has 30% of their earnings in the United States, okay? Then for me, I was like, well, I'm not biased to the UK. Sure, the largest market share or the proportion of revenue share that Boohoo has is actually in the United Kingdom, but I have got geographically diverse revenue streams alongside Games Workshop, who's also geographically diverse. I don't see this as an issue. Now, at first, yeah, okay, that seems fine. And at the time, I was also an advocate for avoiding exchange rate fluctuations, right? One of the reasons I wasn't investing in, let's say, other locations is because I didn't want to risk the exchange rate, which is the idea of having the pound here and having the pound rise in value. So I've bought shares in euro in the currency, but the pound rises, I've now lost money on that investment because the pound has risen. So obviously, if anyone had bought when the pound to dollar ratio was about £1 was buying £1 $7, you know what I meant, not £1 7, but $1.07, then that was obviously probably not too favorable given the amount the pound has rallied recently. However, I think this is more short to medium term fluctuations. As I've been doing my accounting studies, I've come to realize that truthfully exchange rates aren't the hugest impact in the world, and ultimately it depends on what you believe you're going to be using. Do you think in the future you're going to retire in America? Then probably use the United States dollar to denominate your investments. However, again, this doesn't only impact you on your investment level and the price that you've bought at, but this impacts the businesses anyway. And if you've got a big enough business and they're geographically diverse, then they're already impacted by exchange rates. So you can't truly avoid this in the first place. So why really worry too much about it? And at the end of the day, you might be watching the fluctuations of the exchange rate go up and down. But regardless, it doesn't matter until you eventually hit that sell button. So again, and it's unlikely that either of the main currencies in the world, right, the pound, the euro, or the dollar is going to crash significantly in a short space of time that absolutely wipes out your investments. And don't forget, your investments hold their own underlying value, which does mean in the event that this happens or we transition to a new currency, I'm sure that this will eventually be rectified over the longer term in terms of what it can equivalate to. The idea here being if one of my, let's say the pound falls and it goes to zero, which is unlikely in my opinion, the pound is no longer usable as a currency, the United Kingdom now adopts the euro in its place, then I've not lost all my money on my investments in the stock market. It's likely as the pound was falling quite sharply that my investments, and obviously were denominated in the pound, were going to rise in value relative to how much they could buy at that price, and then likely once, it would be a lot more under control, it's not going to rise or drop sharply. But once that's happened, then obviously it'll be, okay, look, we're going to use the euro, and then I could sell those for euro-denominated versions and likely get equivalent or rough amounts of money of what I had before. So exchange rates, as I say, are not really relevant here. And again, that's what I thought at first was meant by geographical diversification. I thought, exchange rates concerned. What about areas of knowledge, right? Well, I'm not going to invest in China because I don't live in China. I've been to China once. I've been to Beijing 1 week before the lockdowns, and I don't know enough about it. I was literally in the airport pretty much as it was a second stop just to go home. So I don't know much about China. Why would I really invest there? And that's one part of the strategy that still holds. It's like, okay, is it my area of understanding? Do I really know how well this brand is doing in another country that I've never visited before? Well, no, not really. I can see the financials, but I don't know what the customer opinion is. I'm not myself a consumer. It's hard for me to understand that, and it goes against my investment strategy in a way, and therefore I've kind of been, away from it. But I've come to realize as of recently, thanks again, Andy, that truthfully what I should be doing is not worrying about what exchange that these investments are listed on. Again, if these companies are geographically diverse, they make their money or their revenue or their earnings in different countries, then it doesn't really matter what exchange they're listed on. They could be listed on the New York Stock Exchange or they could be listed on the Hong Kong Stock Exchange. The idea is that you're buying a listed company and you're able to obviously buy that investment and hold it. You should always remember that the business does not know you hold it as well. So you're just buying shares of that business that you think is of a good quality. And ultimately, if you think there's a good quality business on the New York Stock Exchange at a good price, then why are you holding yourself away from actually purchasing those shares? And I think, truthfully, this is a bias that I think all of us can easily fall into, right? You start investing, you start looking at UK stocks and shares if you're from the United Kingdom, right? You're very interested in that, so you'll be like, okay, what are the best UK stocks? You're hearing a lot about these American stocks across the seas. You've got your Google, your Amazons, absolutely dominating the markets, right? And you're like, well, in the UK, I've got these. Well, okay, there isn't any big companies, big tech, so let's go smaller. Let's look at the AIM markets. The alternate investment markets are quite popular, and I imagine there's a lot of people that are quite biased in terms of that regard that filter in these markets. That said, I do believe that the UK does have its own unique advantages compared to that of the United States, and one of those is for the reason of analysts. Analysts' coverage in UK stocks is a lot less, whereas companies like Apple are heavily scrutinized by analysts, so probably probably has the most analysts covering it in the world. So it's easier to find opportunities, or let's say price disconnections from fair value, and therefore I believe in the UK markets and other markets. Don't get me wrong. Let's say the Japan Stock Exchange, right? Because perhaps there might be less analysis on these specific companies, then you can get a very attractive price to buy in at. Which goes back to this patriotic bias. If I now see a quality company that is on another exchange, is at a fair valuation, is trading at a good price to earnings ratio, has a good level of free cash flow, has low levels of debt to equity, then why would I hold myself from it? If I do think this is truly a good company to buy, the management have got good long-term incentive plans that align truly with the shareholders and solve the principal agent theory or principal agent problem, then I'd be happy to own it. And recently I've been listening a lot and focusing a lot in my investment strategy. I've been listening to a lot of Peter Lynch and Warren Buffett again lately, really trying to focus, really trying to double down on these efforts, make this my priority right now to truly understand as much as I can at such a young age. I realize that I've made mistakes in the last 3 years and I've tried my best to learn from each and every one of them. It's very likely that I'm still continuing to make these mistakes as I'm learning. Like the price targets I set 2 weeks ago, right? Or a few weeks ago, I said I'm no longer allowed to buy stocks until I've set price targets. I'm now coming to the conclusion that this is an extremely difficult thing to achieve because you can't really set a price target without ignoring some factors, and you can't not set a price target by just choosing the current factors that you're interested in. For instance, if you're valuing a company primarily on their earnings, how do you value a company that's unprofitable? Do you avoid them? Well, there's opportunities there. What if this company is unprofitable but has loads of cash on the balance sheet? How do you account for these differences? Like, how do you find a consistent formula that allows you to value all of these companies in the same way? And truthfully put, I've not found that way yet, and I find it quite tough. And again, it's probably going to hold me back a bit, but it's a good learning experience. As I've been listening to a lot of Peter Lynch and Warren Buffett, as I've just mentioned, I've discovered that it's okay to find opportunities in other markets. If you're looking and constantly aware, as Peter Lynch says, of these brands around you, things that you're actively interacting with, there are likely opportunities. I've been looking around, I went to the gym today, and I've been going to the same gym for about 1.5 years, right? And I was just sat there going, every single machine in this room is owned by the same brand. Who is Techno Gym? Oh, okay, they're a European listed company. They've got a good balance sheet. Again, their earnings have been faltering slightly over the last few years, as to be expected, but revenue is back to where it was before the pandemic. This is an attractive company. And I wouldn't have even considered that. I've only just now considered it just by going to the gym 5 times a week for the last year, over a year. I'd only just now seen it. And it's very likely that the gym doesn't even own this equipment and it's leased. Now it's finding out, okay, does the company lease them directly, or is there a middleman there? It's understanding this. And because I'm always now looking around for opportunities, it doesn't matter where they're listed. Whereas before I might have found a company that was, listed on the Europe exchange and gone, oh, well, it's listed in euros, denominated in euros, it's out of my understanding, I'm going to ignore it. And because I was ignoring it, I was throwing away perfectly good investment opportunities. And that is the lesson that I've learned this week. Thank you for watching. Have a fantastic day.